Banking Book Webinar Series 2, Episode 1, Digitization of Enterprise Risk Management, presented by BBA.
Good afternoon, everyone, and welcome to another webinar Series 1, the first episode in Digitalization of Enterprise Risk Management. We have here our CEO, Sohail Farouk. He was at Oliver I. Wyman and HSBC and Moody's as well. And our advisor, Andy Papala, he was previously advisor at OSFI and DICO. Sohail, and welcome, and Andy, and I'll let you guys start.
Perfect. Thank you so much, Paula. My name is Sohail Farouk, and as Paula mentioned, I'm the founder CEO at BankingBook Analytics. My prior experience includes consulting and working with the industry, specializing in areas relating to finance, treasury, and risk domains. BankingBook Analytics is essentially a software development firm, but our focus is on developing the software relating to decision support system for financial institutions around the world. And we utilize software as a service solutions to distribute cloud-based solutions to our clients. What we take pride and what we think is our value proposition is that we customize the software, so we do not believe in one-size-fits-all approach. And another important feature is really our focus on data analytics and providing decision support system using precision analytics. In addition to that, we also assist clients with advisory in the areas of or in domains where we have expertise. Before I start with this presentation, I'll pass it on to Andy for his brief introduction, and then we'll kick off the deck.
Thank you, Sohail, and good afternoon, everyone. It's a pleasure to join you today. My name is Andy Paprava. I'm a senior advisor to BankingBook Analytics. I've got a long history of service to the financial services community, both as a regulator and as an operator. OSFI for 10 years in the banking supervision area, as well as insurance and pensions. And more currently, after that, in the credit union space in the Ontario government with the regulatory agency there as well. I currently do a lot of work internationally with a number of regulatory agencies, helping those agencies to understand the kinds of oversight that they need to have and understanding what kind of risks are going on around us. So pleasure to join you this afternoon, and look forward to the conversation with Sohail. Thank you.
Thank you so much, and welcome everyone. It's great to have you all today. This is the first webinar in our webinar series number 2. Our target is really to do a webinar every month, and this allows us to really engage with our clients. Not just that, this also helps us understand the challenges that our clients face because of the Q&A approach that we follow. And second and foremost benefit of attending these webinars is really around knowledge transfer. As Andy mentioned, he brings a wealth of experience, not just local, but also international. He has seen several cases, advised CEOs, boards, and senior C-suite folks. And this helps us to sort of understand the challenges which we are facing in a very uncharted territory as we enter the second wave of COVID-19. With that, of course, what sort of resonates is not just the complexities in terms of understanding the macroeconomic impact on the financial institutions, macroeconomic impact on the balance sheet and P&L, but also how and what sort of strategies, what tactical advantages can be deployed on a short-term basis. So when we talk about digitization of enterprise risk management, what that really means is that enterprise risk management has been a discipline, has been an area of practice for quite some time. But taking a leap forward and understanding what technological tools are available out there and how they can be applied in terms of understanding and recognizing the empowerment that data is potentially providing us, and using that in developing the decision support system. So here on this slide, what we are showing is really an outcome of our several decades of experience, where we've taken these modeling applications, curated them into software which is deployable to our clients. And each one of these applications really reflects, how data is sliced and diced, how the data is captured, analyzed, and manipulated to get the results. Without further ado, I will, without further background to the modeling applications that we have, I would move on to the topic on hand. So at a very high level, what technology and data implies really. And the challenges that the organizations face are numerous when it comes to understanding the data and how it can be used as a tactical or a strategic advantage. The first and foremost challenge is really understanding what is a single version of truth in terms of data. So there could be data that is being provided by the core banking system. There could be data that could be leading or lagging, and our ability to understand that how that data can actually present a succinct picture for the C-suite is really around describing the single version of truth. The second important aspect is around the application of this sort of single version of truth in enterprise risk management. Now, enterprise risk management is really a craft which surrounds the identification of material risks and analyzing and assessing those risks in terms of understanding how effective our lines of defense are, and using those as to further determine that what are potential vulnerabilities that exist and how these vulnerabilities can then be addressed and organization can be made resilient. So a case in point is really looking at, let's say, the potential of increasing defaults in a mortgage portfolio, and understanding that how this could have an impact or a series of impacts on not just the defaults themselves, but the foreclosures potentially associated with those mortgages, the impact on, from a liquidity perspective, on cash inflow, and then finally the impact on capital. So all of these are interconnected, and what we are trying to demonstrate in today's webinar is that how this can be used from a strategic advantage perspective, and insights can be developed to kind of eliminate and to understand the vulnerabilities and mitigate those risks.
Well, if I could just jump in on that, Sahil, just in my experience and my practice, I've seen a lot of organizations, credit unions and small banks that are using manual systems to collect data and assess risk. Can you just comment a little bit about the benefits of using, a more disciplined and integrated system?
Certainly, Andy, and I think what I would like to do is really jump to slide number 13. So this speaks to that. So essentially, if organizations do not have a control on their data, what they're doing is really sort of scoping out or farming out or outsourcing their competitive advantage to vendors or to the peers, not knowing that how they can utilize and manage this data internally. So a great sort of current situation analysis is that most of the data that is currently available within these organizations is in core banking system, which we are calling here in this slide as source systems. And once this data goes through these source systems, especially from a risk management perspective, it does not get captured. And by that, what we mean is that, there is no staging ground and there is limited data warehousing, which is being done precisely from a credit risk management perspective. There could potentially be, if an organization is actively involved in trading, both fixed income or equity trading, there could very well be an ALM system that could be in place. But when it comes to credit risk management, there is very limited data that gets captured. So essentially what happens is that if credit applications from a strategic decision-making perspective are deployed, most of the data gets harvested from the source systems, and it is fed right into the application. So as you can see at the bottom of it, we have an arrow that takes us right to the risk application without really or circumventing the data warehousing or data mart principles which are associated with managing a credit risk-based data, both from a default perspective as well as a collateral perspective. So that essentially means that there is no control that the organization has on its data. And the second important point is that they're really farming out their own competitive advantage to an application which might be able to give them some decision support, but it would not allow them to further analyze the data to be able to come back with even a historical analysis. Let's just say if you want to go back to or refer to situation that prevailed in 2008. So that's a big challenge, and I think that's an important aspect that needs to be kept in mind.
Great, thank you.
So indeed, so I think you're welcome, Andy. So I think the proposal that from a data architecture perspective is that the data lineage, purely from a risk taxonomy perspective, needs to be organized and needs to be kept in an enterprise data warehouse, and more preferably in a risk data warehouse, or risk data mart. And really that would allow the organizations to be able to access the data in times of crisis. That would also allow the organizations to be able to actually further develop a further analytic power to be able to understand and forecast the outcomes associated with data analysis. A good example here is really designing and developing a commercial obligor scorecard, for example, in commercial real estate. From a behavioral perspective, which we call the qualitative factors, and also from a quantitative perspective, which we call the financial factors, it is important to have a data that encompasses, or a history of data that encompasses a full business cycle, which is approximately 8 to 11 years. So having that power available within a data warehouse would allow the organizations to develop perhaps a more refined and what we would call a more discriminating scorecard, which then can have a favorable impact both from its application in pricing as well as in its application in developing the capital allocation and assignment from each obligor.
So one of the, on that point, one of the things that a lot of institutions, sort of struggle with is when you're using past data that's in the data warehouse from the last, cycle of business activity, how is that modified so you can make sure that, because future cycles may not look the same, how do you modify that those risk factors to make sure that it's up to date and current? How would you do that?
Exactly. So that's a very interesting point, Andy. And first and foremost is that, we need to be able to understand that which factors from a long list of data which is available are the most predictive from a default perspective. So, of course, there has to be some kind of a rank ordering of these factors. And this is done using what is known as power statistic, which really is an algorithm that allows modelers and statisticians to come back and say that the ability of this particular factor to be able to forecast the default ranks higher than, let's say, a factor Y. A good example is, for example, from an obligor's perspective, a retail obligor's perspective, a loan to value. Is this an adequate power statistic? The second example could be, the tangible net worth. So having the understanding of the history available for these two factors, and then what is known as the factor analysis, and analyzing that, what is the predictive power, which single factor analysis allows us to do that, would really give us answer to point number one, that, the predictive power ranks higher, for example, in the case of loan to value compared to tangible net worth for a certain segment of obligors. With that being said, and that being identified as a predictive or as an independent variable to predict the dependent variable default, the next step then becomes is that how do you make that a forward-looking? And that's where really what is known as the calibration of defaults come into play, which allows us to really determine that where we are in the business cycle and what is the forecasted trajectory of the business cycle, and that allows us to really calibrate it from a business cyclicality perspective. And that incorporates what is known as a forward-looking measure to that, and that control is really available when we have historical data otherwise, we may end up using industry benchmarks. We may end up using external pooled data. However, that may not really be considered as accurate as having internal data and internal default experience brought to bear in developing these type of models.
That's great. So that means that when the board of directors or the regulator or whoever looks at this, the modeling that you're doing, they can see how you've used historical data going through your process to modify it so it's a forward-looking document as opposed to just simply a historical document.
Absolutely.
Thanks. It's great.
Okay. So now that we understand the importance of historical data and its availability and ability to access the data, what then becomes important is that is really how do we govern that data and what kind of tools are out there which are available from the perspective of data governance, data storing, and so forth. So this is really a transformative shift, from having to look into the paper files, having to be able to understand how we can capture that data, but at the same time using a historical data analytic, which is available, archived within the data warehouse or data mart, and to be able to use it. So an important leap forward. From that perspective, we have created this slide, which is really around data governance. Considering that data is an empowering intangible asset that financial institutions have. So if you were to actually look at data purely from a bottom up, this slide where we have, say, data that comes out of lines of business, for example, commercial real estate, retail, HELOCs, and all the other lines of business, and then how it runs through the source system and then gets extracted from the source system where we check the logic and integrated within a data repository. So data then gets plowed into the data repository and then becomes, through the process of the manipulation and application of data that we just described, it becomes part of an integrated risk-based management information system. So in other words, you can have data being reported. But on the right side of the slide, what you see is really a framework which allows organizations to be able to start capturing the data. So it might just sound quite simplistic, but really at the top of it, what we want to know is that what are the material risks that an organization faces? And what are the trends that need to be captured from those material risks perspective? So that really goes to the heart of enterprise risk management. Once that is identified and these risks are taxonomized, then the next step is really creating an assignment from a data ownership perspective within the organization. So a great starting point is having a data governor, available, who can define the data labels, who can define the data dictionary, and then start controlling the input of data. And as we said earlier, the extraction and logic checking of the data, and then it streams through the entire organizational hierarchy, going all the way down to the data councils, which sit around these individual risks and are able to capture it. So a good example is really around operational risk, where within the context of operational risk, the framework that is used is allows organizations to convert an inherent risk into a residual risk. So by converting or transforming an inherent risk into a residual risk, an organization signs off on the control features, which allow the organization to really turn those risks into residual. So those control features, if those control features are essentially, they get jammed or they do not work in time of crisis, the question then becomes that are we capturing the inadequacy of controls, or are we circumventing how the controls are flowed? So that's the sort of next part in terms of understanding that how data can be plowed in, and even the future data that can be used in terms of understanding the weaknesses of controls. So that's a sort of data hierarchy that can be brought in.
So in this model that you're talking about in terms of data governance, where's the role of the chief risk officer fit in? How does that individual in the organization sort of work with this kind of a structure?
Exactly. So what we're looking at are data consumers and what we would consider as the data providers. So the chief risk officer and his team, including, let's just say, the entire C-suite, which would include the CEO and the CFO, become the data consumers within the organization, while the data providers are essentially the front line and the interface that exists from a data governance perspective between the front line and the data consumers, and that's the sort of approach that sort of prevails and is emerging from a best practice perspective.
Great, that's helpful, thanks.
You're welcome. Great. So we talked about really how data can be used to transform enterprise risk management and create what is known as a digital set of records, which can be used to develop internal applications as well as can be used from an input perspective into the external application or vended applications. With that being said, I think what becomes important is for us to understand that how data can allow organizations to become, from a tactical perspective, not just tactical, but also the strategic. So tactical plus a strategic outcome. From silos to essentially a horizontal hierarchy which allows data to be used from a competitive advantage perspective. And its application really goes not just from a risk management or capital management, but also from a product creation perspective. So understanding various nuances and creating these products. Right. So this is sort of a case study, a brief case study that allows us to really look into how competitive advantage can be drawn by applying data in terms of creating the scorecards that we talked about, and then creating enhanced applications. So we thought that we should run by some of the slides that we used from a research perspective. Okay, so the starting point is really around a consumer or customer acquisition in credit union space. Of course, we would refer to that as member acquisition, and then we go through the entire credit journey. Either the outcome is a loan is repaid, or a loan is foreclosed and then it's collected and recovered, or partially collected and recovered. So within that, we have these discrete steps. We've acquired the customer, it was underwritten, and then, you undertake the monitoring, which includes reporting and so forth. And then, you continue to manage it. The idea there is for relationship managers to cross-sell or to upsell. And as I said earlier, it gets repaid. There is really no point, but if it doesn't, you're foreclosing and you're sort of referring it to collection and recovery. For each one of these discrete steps, what we want to know is that what kind of data is required and what kind of data needs to be harvested. From a data governance perspective, the data fields or data labels need to be created here. They need to be defined, and they need to be made part of an organization-wide data dictionary. So that's really an important aspect here when we look at the data governance. Now, if you were to actually go to the next stage of it, we can see that if we have such empowering data, a lot of these decisions which relate to account management, upselling or downselling, can be really made automated from the perspective of, say, retail obligors or retail members. But when it comes to the large borrowers or commercial borrowers, which are underpinned by complex transactions, this is of course still a manual process. So by capturing this data, a lot of the manual work can then be made automated. So that's a sort of a guiding principle from a process design perspective in terms of understanding the data and using it and applying it from a portfolio management and client acquisition perspective, and even from product creation perspective. Okay. So again, this application can be even enhanced. We can develop policy filters. We can enhance our what is known as the customer acquisition criteria. With regards to what kind of limits are available based on certain bands of LTV, what kind of limits are available based on certain credit scores. So that sort of addresses what is known as the risk acceptance criteria. And then the second part is really on the flip side of it, what is a return acceptance criteria? So what kind of return is acceptable based on a certain band of LTV and based on a certain credit score, which also sort of is potentially an automated process. And so all of that can then lead us into what is known as a fully automated underwriting process for lower complexity transactions, notwithstanding that a lot of these insights can also be used for more complex syndicated loan transactions as well. I hope it's clear to the audience. If you have any questions, please feel free to ask. You can shoot it in the chat box, and Paula can share that with us. Okay. Right. So as we talked earlier, that the application scoring, which allows us to really automate these decisions, is really part of an outcome of an elaborate data analytic process, which is really underpinned by an application acceptance scorecard. So that's the sort of key building block for data-based credit decision support system. The second important part is really around the redesign of the process. How this process can be streamlined, what is the range or what is the limit associated with certain bands, and how that can be tweaked using the policy infrastructure that we have. And again, from a return perspective, how that can be used as a differentiating factor, which would allow key benefit to minimizing the prepayments, especially in the mortgage loans or the mortgage portfolio. Prepayment is emerging as a big challenge. As rates drop, a lot of the borrowers are trying to either walk away or trying to sort of attrition, primarily because they're shopping around for the lower rates. And now, if they're being treated from a risk acceptance perspective, really on a fair or level playing field. Andy, your thoughts and comments?
Well, you're on this next slide. I'll talk a little bit about this. This is the whole issue of applying credit scoring to automated decision making, and it was interesting this slide that when you showed it to me, I was interested in this what this actually means. Does it mean that a lot of credit unions, and I don't know where you got the information from, so maybe that's part of the issue, is how many credit unions are out there doing what you're talking about, and why, if they're not doing it, why aren't they doing it?
So this is really, that's a very good question, from the perspective of this sort of bringing forward this slide is really an outcome of our research. One of the things that you notice from within the credit union and mid-sized banking space is that there are certain portfolios which are really part of the core target, the entire balance sheet is really being used to actually focus entirely on those portfolios. To give you some examples, one of them is really on residential mortgages. A lot of the effort is sort of to understand that, and penetrate further within the communities to further the mortgage loan book and to enhance the size. So there's a lot of competition that is out there. But with that being said, there are certain other important segments, credit portfolios, which are being overlooked. And small business or SMEs are being one of those. And we identify that time and time again, and especially in a post-COVID situation where the government has introduced SEBA, which is essentially the emergency benefit available to the small businesses. This opens up a whole new world of opportunities to mid-sized lenders in Canada. And I think focusing increasingly on the mid-size and small to mid-size enterprises is important because it allows them to not just diversify from their core focus on real estate and mortgage-based or residential mortgage lending, but to also sort of kind of open their door to what is known as quasi-sovereign risk, because it's government guaranteed. So, but before COVID and before the rollout of SEBA, what we had seen was that there was very limited focus on understanding different pockets of revenue and then aligning their tools and aligning their technologies and increasing the size of their risk appetite to start lending to this particular segment. So SEBA has, of course, inadvertently exposed credit unions and mid-sized banks to actually this particular segment. But as I said earlier, this could potentially be driven by the market pressure. Another sort of driver could very well be availability of pooled or bureau data. Let's just imagine for a second that there is no bureau data available for residential mortgage lending. What kind of tools would be required really to offer loans to the obligors to buyers of houses or real estate? So that sort of infrastructure is readily available, is externally available based on a small fee, and that lent itself really to kind of focusing more and more on an outsourced basis where you are really outsourcing your data analytic and your intelligence of certain obligors and deriving that. But in cases where some opportunities did exist, pockets of revenue are available, are still being considered as white spaces for small to mid-sized banks as well as for the credit unions.
Right. So what you're saying here is essentially a disciplined approach to, especially in small business lending, putting in place these kinds of controls that you're talking about and inputs with respect to the data that's available is going to make the decision-making process more efficient, but mostly more as well as being more prudent, I guess I'll call it, going forward. And this obviously is a growing area of space for credit unions in Canada. And so therefore, this becomes an important aspect of risk management.
Great. So, as we said earlier, the idea here is to identify the open spaces which are out there and be able to either internally develop the tools, internally develop the intelligence and ability to analyze these obligors without much reliance on externally provided data. And the second sort of side of the equation, or the other side of the equation, is also to sort of diversify the portfolio, which would sort of limit the reliance or reduce the reliance on real estate. So that's a sort of overall emerging picture here. And then the final piece is really looking at the costs which are associated not just with deploying or developing the tools, but also sort of, what kind of analytic power is required. And then, as we said earlier, that, the power stat, which is really an outcome of or ability to discriminate different factors in terms of their predictive power, is an important aspect, and that also requires some sort of internal analysis, because if you were to look at these independent variables, you can only work with a certain limited set of these variables. Having an extensive lineup of different variables might really lead to what is known as a multicollinearity error, where certain factors actually offset each other and do not really provide you with the kind of predictive power that is required. And of course, then harvesting all of that and developing the pipelines using in conjunction with the front end or with the relationship managers kind of enhances what is known as a virtuous cycle of digitizing the credit-based enterprise risk management. So the overall focus really is, from the perspective of customer acquisition, is to drive a value-aligned performance, where we are looking at value being provided within each discrete step that we discussed, all the way from customer acquisition to the disposition of the customer, either by way of repayment or by way of foreclosure or default. So each one of these steps should have a value enhancement and should be able to leverage data associated with within the underlying steps that we are referring to here. Okay.
So one of the questions that many CFOs are going to ask is, when you do all these things that you're talking about, how do we know that there's a net benefit to the organization? You're going to invest all this money in technology and new processes, and where at the end of the day does the organization benefit from it? So maybe you could just talk a little bit about that.
Well, that's a good question, Andy. And I think one of the things that we need to bear in mind is that when we are actually acquiring each one of these assets, we need to be able to understand that is this asset a capital accretive? In other words, does it add to the capital or the bottom line of the organization, or it ends up diluting or reducing our capital? So by having the sort of empowered data that we have, such decisions can be made. Now, I would actually refer to one of the previous webinars where we actually presented a study in which we showed that, with the exception of big 5 banks, the remaining sort of in Canada, of course, the remainder mid-sized or smaller banks are at the cusp or are in an area where they're using capital dilutive approach to acquire every additional customer or client, And this could very well hold true for some of the credit unions as well, that unless such sort of deep analytic is reviewed and analyzed from the perspective of the members, the capital providing members or the capital contributing members, we would not be in a position to understand that by adding additional obligors, we are creating capital for the members, or we are diluting or reducing their capital. Another way of looking at it is really from the providers of capital perspective, that what kind of return are they expecting? Are they expecting the return which is really based on a certain opportunity cost, and that opportunity cost is potentially a return which they can seek, let's say, from a private equity transaction or from another sort of set of transactions, which could be investing in a publicly traded enterprise and so forth, or this particular return that they're getting is in line with the benchmark return. Now, looking at that benchmark return, we are talking here high teens. We're talking about a return which is really on a risk-adjusted basis about 15 to 18%, which is known as risk-based pricing or risk-adjusted return on capital, which should be over and above the hurdle rate. And by hurdle rate, what we mean here is the minimum acceptable return to the equity providers or the capital providers of the organization.
Great, and in terms of investment by the credit union or the bank, and putting something like this together, and perhaps doing a business case to support that, how would you go about doing that? In your experience.
Well, that's a great point. So, enterprise risk management framework allows us to identify what is the return on investment associated with each one of these projects. So, for example, as I talked to you or talked earlier about every new transaction being either a capital accretive or capital dilutive transaction. So in the absence of having these tools, it's very easy for organizations to be able to understand that are they really generating the return which is in excess, and if it is not in excess, that what kind of investment is required. And that would allow them to really to determine the return on investment with regards to developing such a technology and using that as a strategic asset, which would allow them to really start sort of, understanding and developing that analytic. And quite frankly, one of the things that, comes to mind is really understanding the risk profile associated with each and every obligor or member, borrowing member that is brought on board. Having a better understanding of these members would also, as I said earlier, reduce the attrition rate with regards to prepayments. And if that is not being done now, then we could be very well in for a big surprise where we can see an en masse transition from a status quo to someone who's providing the lower rates or who actually understands the risk profile of this segment better than the current organization. So really the cost of status quo is not acceptable in most of the cases. And that is, of course, that is going to manifest itself, if not now, in the near future. And all of that would be reaped into an ROI-based framework.
That's great. That's very comprehensive. Thank you for that. Appreciate it.
Thank you.
You're welcome.
Sorry, I do have a couple questions here that I received. So the first one is, what data warehouse technologies are available?
That's a very interesting question. Of course, there's quite a wider spectrum which is out there from a data warehousing perspective. And as we said earlier, the first and foremost really is understanding that, what are the risks which an organization is exposed to, and then some of these data warehousing technologies are essentially plug and play, so you can essentially create the data fields on the fly, and these data warehouses can start collecting the data and would allow you really sort of to be able to kind of use that in development of these applications and technologies that we just talked about. So it's not really very complex, and they're not really very huge investments either, but it empowers the analytics relating to data.
Great, thank you so much, Sahel. The second question would be, how can we kick off the process?
Right, that's a very important question, really. I think what is important is really for us to understand that, what are the available technologies within the organization. So most of the organizations that we see already have a fairly great core banking system. They may even have an ALM system, or they might have even outsourced it to external providers. So from a core banking system perspective, I think what we need to understand is that what data fields are being captured currently, and are they aligned, or are they meeting the requirements of developing this data lineage that we talked about from, let's say, credit perspective, or from sort of entering into new lines of business perspective. So that's the sort of first and foremost task, that we understand that what is our source system. The second is do we already have or existingly have any data that is currently being captured, and how that data can be utilized or can be extended. And the third is that, what kind of applications are out there. As I said earlier, an ALM system is potentially available in most of the cases. So is that system really capturing some of the ancillary level data that we require, or is it really is this data not being captured? So if these applications and source systems have the capability to start capturing more data, then that can be utilized. If they don't, then of course, either a new data warehouse can be brought in, which, as I said earlier, is not a massive investment, but you may want to be able to understand that what data would be needed to be staged, and how these two applications or systems can speak to each other using an ETL framework, or whether or not it will be not possible for them to speak to each other. So those are some of the key questions that need to be answered, over and above understanding and recognizing that what data is required to be captured.
I think also, if I could add, Paula, that in our experience with some of our clients, we've also noticed there's a possibility and an opportunity to, as you go through the identification of sources of data and the kinds of data, to actually implement enhanced data collection processes. In other words, maybe you should be collecting this information in any case, and maybe there's a simpler way to do it without having a lot of infrastructure expenses to reformat what you have or what you don't have. So I think it's also learning. I think it's a discovery and learning process at the front end, which in some cases is actually
Sounds great. Thank you so much, Annie, for adding that. I think what happens is that many financial institutions are just not prepared enough with that data. They need to be more conscientious of that, and even if they're looking for this for the future, to start now, so it's not that complicated. I think that's all I have for questions for now. Any other comments before we close, or any other questions? No?
Well, I would just offer a final suggestion in this area. This is not going to this process of enhancing risk management through data collection and data manipulation and ultimately analysis is only going to get more intense over the next little while, as the whole sector, both financial services and other sectors too, start going through digitization, optimization, I'll call it. We're seeing this already in other sectors of the economy. Healthcare is going to go through it. I think transportation and logistics is going through it now, and financial services already started, but I think it's going to continue on going forward. So financial services is not immune to this kind of environment. So I think it's important for credit unions and small banks to think about what the future is going to look like and what tools they're going to need to be able to manage risk in the future. So just some thoughts.
Yeah, completely agree. And I think we've seen that enough with our clients as well. So I think that's it. We're going to close our session. Thank you so much to Hal Farouk, our CEO, and our student advisor, Annie Paula. And we look forward to seeing you in our next webinar. So thank you so much, and have everyone a very great evening.